That's right, we're coming to you from the Investing in African Mining Indaba 2015, and the conversation and interaction has really gotten underway today. One of the topics on the agenda, unlocking greater shared value for all stakeholders involved in the mining sector. Colin Coleman, who's partner, MD and head of investment banking at Sub-Saharan Africa at Goldman Sachs, has been amongst the speakers on that topic, and he joins us right now. Thanks so much, Colin, for your time today. So the preface to the dialogue that you've been a part of today, mining can boost economies and present opportunities with a better future, but stakeholders need to agree on how to actually maximize off those opportunities for greater value. How far do we sit from agreement in your books?
We need to get a better balance between how we share the costs and the profits of mining in South Africa and in general in the African continent. And because we have a reasonably stressed environment of low growth and low mining commodity prices, that means that there is less room to maneuver, and we need to get this right. This basically means that we need to reduce the costs and increase the profits, but have a conversation about how do we share in those costs and how do we share in those profits in a way that incentivizes long-term sustainability. And
until that agreement does come to the fore, in the interim it's costing economies, whether it be South Africa, Zambia, Zimbabwe. So where does that conversation need to start so that African business and governments can actually be able to leverage optimally?
There's an element of we just need to implement the good legislation that's in place, get in place a more seamless labor environment, and get the communities and business to implement better. And there's an element to which we need to combine and talk cross-sectorally about how to be better at all of this. In the case of South Africa, when we have long-term strikes, we have energy output declines, and we have greater cost of production. That's not a good combination of factors. And more than anything, we need jobs and we need growth in the economy, and the businesses need to be able to be part of that.
Of course, we had Minister Ngwako Ramatlhodi this morning seemingly saying the right things, but sticking to the surface and skirting around quite a few issues around policy, particularly pertaining to the oil and gas space. And then when it came to the national champion for mining, the practicality of something like that was elusive. So are we really getting to outcomes-based dialogue? Look,
I would be quite supportive and sympathetic towards the minister today. I think we have as good a minister as we can hope for in Minister Ramatlhodi, who went out of his way to talk about legislative certainty and to talk about government tackling the labour issue decisively. I think that was good. I think the Seckam and energy issues are far more vexing, and there's not really a credible response to the fact that we have 12,000 megawatts of power not working at this point in time. So we really need to execute and implement these things better. For his part, I think he's trying to get that going. I think business, Chris Griffiths, for example, talked about mechanization of mining, which is good on the one hand. On the other hand, we need to employ more labor, and we need labor to come to the party in terms of a more seamless interaction with business.
Another CEO, Mark Bristow of Randgold Resources, I was chatting to him earlier today, and he touched on something that he said before. Governments need to catch a wake-up on the impact of failed mining industries. Do you agree?
Yes, I think Zimbabwe is a very good case in point where if you literally land grab and license grab, you disincentivize investment. And so what I talked about today was the fact that we need to be smart in the way we regulate, particularly in a low profit environment, to allow for greater capital investment and allow for greater labor employment in this type of economy. Perhaps we need to, for a certain period of time, decrease the costs to business of the overall regulatory regime to make that happen.
So let's focus on business for a minute here. Falling commodity prices, rising costs, those sit amongst the factors that are triggering somewhat of a shift in the landscape with M&A activity, consolidation in play as miners restructure to survive. And we always hear that at conferences like these, more than the conference itself, it's the deal making behind closed doors that steals a lot of attention. And you don't have to give us any detail on this one, but has this year's Indaba been more abuzz than usual on that front?
Well, I think, look, the stage is set just from a pure valuation point of view, if you look at the gold sector, you look at the platinum sector, and you look generally across the diversified sectors, the valuations are really reflecting this environment of low growth, low profitability. But you know what? It'll come back. In 5, 10, 15 years, whatever it is, we will have a new cycle reflecting in world growth, reflecting in higher commodity prices, the supply and demand balance changing. And we'll look back on this time as a very good time to have bought into companies, to have created larger asset bases and created consolidation and synergies in the industry.
Colin, always a pleasure. Thanks so much for your time today.
Pleasure.
Of course, Colin Coleman is with Goldman Sachs.